Every day, millions of shares change hands simply because an investor read a flashy headline or saw a stock chart trending upward. They hit buy without verifying a single piece of actual financial data. Putting your money into a business without checking its underlying metrics is functionally equivalent to walking into a casino and throwing your chips on a random number. The antidote to all this market noise sits in 3 specific publicly available documents: the income statement, the balance sheet, and the cash flow statement. Mastering these 3 documents is the only reliable way to strip away a company's public relations illusion and see exactly how healthy the business actually is. We start with the income statement. Think of this as the company's operational report card for a specific block of time, like a quarter or a year. The math here is straightforward. Total revenue comes in at the top. You subtract all the operational expenses, and the remainder at the bottom is your net profit, or your net loss. This is where beginners get caught in the profit trap. They see a press release boasting about explosive, record-breaking revenue growth and immediately assume the business is thriving. But this split-screen graphic exposes the trap. On the left, we see top-line revenue climbing by 40%, but on the right, net profit is actually dropping by 12%. A company can dramatically increase its sales volume while simultaneously accelerating its financial losses. Top-line revenue growth is a completely meaningless metric unless you can verify it is driving bottom-line profitability. Next is the balance sheet. This document is a strict inventory of exactly what a company currently owns, its assets, versus what it legally owes, its liabilities. The most critical metric to pull from this page is the debt-to-equity ratio. This tells you exactly how much of the company is propped up by borrowed money compared to actual ownership capital. This exposes the debt trap. When consumers are spending and the economy is booming, heavily indebted companies can easily cover their interest payments and appear completely stable. But the moment a market slowdown hits and operational revenue drops, the illusion breaks. Rigid debt payments do not pause for a bad quarter, and that financial weight can drag a company into sudden insolvency. Analyzing the debt-to-equity ratio is the only reliable way to verify if a business model can physically survive a dry spell. The cash flow statement strips away accounting rules to track the literal movement of liquid money. Look at this operational diagram. This exposes the paper trap. The main system is legally labeled profit, but underneath, actual liquid is rapidly leaking out. A company can report a positive net profit on paper, while simultaneously running completely out of cash to pay immediate bills. You actually want to look for the secure reservoir at the bottom, free cash flow. This is the usable capital remaining only after all daily operations and necessary investments are paid in full. Profit is an accounting theory. Consistently positive free cash flow is undeniable proof of survival. Once you have these baseline numbers, investors use valuation ratios to make sense of them. The most common is the PE, or price-to-earnings ratio, which is a mathematical shortcut that calculates exactly how much you are paying for every dollar a company earns. There is a widespread misconception that a universally high PE ratio means a stock is dangerously overvalued, while a low PE means it is a safe bargain. These side-by-side charts expose why that thinking fails. Different industries have completely different baselines for growth. A high PE is entirely normal for a fast-growing tech company, but that exact same number would indicate massive overvaluation in a slow-moving utility sector. Any financial ratio is entirely useless for decision-making unless you are comparing it directly against competitors within the exact same industry. The final layer of truth requires avoiding the snapshot trap, the danger of judging a company's overall trajectory based on a single impressive quarterly report. Companies know how to optimize their operations to manufacture one highly successful, isolated financial quarter to appease investors. Looking at this tightly cropped chart, the short-term growth looks incredible, but watch what happens when we zoom out. That singular great quarter was completely masking a massive 5-year structural decline. The true health of a business is not found in a standalone metric. It is strictly found in the multi-year direction of its financial trend lines. So, the complete framework comes down to this: verify profitability on the income statement, check debt levels on the balance sheet, confirm actual cash flow, contextualize your ratios, and demand multi-year trends. Identifying a safe investment does not require a specialized finance degree. It merely requires the discipline to look past the hype and ask the numbers the right questions. This is strictly educational content, not personalized financial advice. Always do your own full research before investing. If this breakdown helped clarify the numbers, hit subscribe and drop a comment below. Which of these 5 financial tools do you find the most intimidating to analyze?